You're going to lose money in trading, whether you're doing things right or wrong, right? So let's not have any losing trades due to errors that we can avoid. And that's what we're going to talk about here. One of the biggest problems is not having a clear trading plan. So when you have a clear trading plan, whether you're just starting out or you've been trading for years, without this, you're vulnerable to poor practices. You're vulnerable to committing costly mistakes that could cause some pretty big losses. So before buying stocks, you got to have a trading plan that includes risk management, your entry points, your exit points, position sizing, a whole bunch of things. And risk management is key to protecting our accounts, right? It's really important to set limits on how much you are willing to lose per trade. So that way you don't blow your account with one trade that goes wrong. So the ability to accept losses, that is the hallmark of a professional trader. Our entry and exit points, obviously they refer to where we're going to enter the trade, where we're going to get out, and how we're going to get out. All that has to be predetermined. Position sizing, how many shares of a stock or contracts of an option are you going to buy? So this is going to help ensure that your trades aren't too big relative to your account size. And it's also important, don't get too attached emotionally to any particular trade. Instead, focus on all the rules that you've laid out in your trading plan. So if things start to go wrong and they go wrong quickly, you have an established stop loss to get out at. You also have a way to allow some room for potential recovery if the conditions get a little bit better. Tracking performance over time, crucial. You need to do that to identify areas where improvements can be made, as well as understanding what strategies you have that work best under different market conditions. So a bull market, a bear market, consolidations, trending, all different. Another issue, overtrading, taking on too much risk. It's a common mistake. We've all done it, especially those who are new. Overtrading generally is a result of greed or the fear of missing out and revenge trading. Instead of focusing on quantity, focus on the quality of your trade. Take fewer trades with a high probability setup. Helps reduce your risk, increase your profits. And it's really important that we do not get caught up in the moment or chase hot stocks that fall outside of our trading plan. Again, track your performance over time. And make sure you review them as well. Another issue, not having a proper risk management strategy. It's indispensable. Risk-reward ratios are one of the most important aspects of successful trading. Understanding the potential reward versus the potential risk before you make any trades is going to help you make a better decision. So you got to realize that every single trade carries a certain level of risk. So no matter how developed your trading strategy or your trading plan is, there's still chance for losses. So it's critical for you to have an understanding of your risk tolerance and develop your strategies accordingly. So one way traders can manage risk is set stop loss orders on every single position. So this is going to allow you to limit your downside exposure, but still allow for the opportunity for profits if prices move in your favor. Also consider trailing stops, and they're going to adjust as price moves and lock in your gains. This is a way to profit from extended price runs because we never know when those big moves are coming. Another issue, letting emotions drive our decisions. Traders, we're our own worst enemy. When we let our emotions cloud our judgment, cloud our decision making, it leads to errors that probably could have been avoided if we remain disciplined. So we got to be disciplined and we got to stick to our plan. And there's fear, right? It's one of the most emotional traps out there for us. It can cause us to hesitate when making trades, or even worse, not make them at all. And this fear-based hesitation, it's going to lead to missed opportunities as well as losses from holding on to positions far too long or exiting them far too early because you're afraid of losing. Greed, another emotion, gets it in our way. We become overly aggressive with our positions. We take on excessive risk because we want to maximize our profits. And this usually ends up backfiring over time because markets don't move in a straight line. There's always going to be volatility against us along the way, right? We don't want to let excitement cloud our judgment when it comes time to enter or exit a trade, because this often leads inexperienced traders down a path that's going to be filled with poor decisions. It's going to be based on wishful thinking instead of trusting the plan. So we got to remain level-headed during winning streaks and our losing ones if we want any success over time. One of the worst end in life is regret, and it has no place in trading. Regretting your past trades, regretting your past mistakes, it does nothing but distract you from focusing on what matters most, which is future performance, future improvement. We get that through proper analysis and our discipline. So we got to strive for discipline. We have to strive to be objective. We have to strive for clarity when it comes time for us to execute our strategies. Because if we don't, we're going to find ourselves spinning our wheels as we make mistakes mistakes that could, in the long run, cost us our trading account. Focusing too much on short-term gains and losses. This is a common mistake again, right? It's tempting to try to make a quick profit, by buying shares quickly, but successful traders tend to take a longer term perspective. Short-term gains made during a momentum move in price, they're nice, they are, when they're around a proper plan, but they're not normal. When we focus too much on those short-term quick gains, we tend to forget other aspects of trading. We tend to forget risk management. We tend to forget tracking our trades and our performance. Can't say it enough. Risk management strategy is crucial for managing our losses, while tracking our performance over time is going to help us identify areas of our strengths, our weaknesses, not only personally, but in our trading strategies. When we take a long-term approach, we make risk management and performance tracking and review important. We can and we will make better decisions about our trades, about our strategy, and we're going to improve our chances of longer-term success. So it doesn't matter whether you're looking for long-term capital appreciation or consistent returns every single month as income. You focus on those essential components that's going to help you achieve those. When you're stock trading, what about trading low-volume stock? It is a recipe for disaster. So what's volume? First, it's just the amount of shares that's transacted over a certain period. Okay, so it's an indication of how active a stock is being bought and sold. So high trading activity, it makes it simpler to enter or exit our trades without having a great effect on price changes or encountering slippage. Low volume, well, that indicates there are fewer buyers and sellers in the market for that particular stock. We get gaps, we get slippage. Low volume stocks, you got to avoid them by most people. So why is volume important? Because again, it gives us a glimpse into the liquidity levels and trader sentiment of a particular stock. Our low volume stocks, we could find it difficult to enter and exit without slippage. This can cause us getting in or out at worse prices. Now, when our stop gets slipped, that's a large loss, or it certainly can be. Lower volume stocks, they may not follow the broader trend of the market. They're a little bit more easy to manipulate, right? Think of the pump and dumpers. It's very common with low volume stocks because it takes very little buying interest to drive the price up. And the one who started the pump and dump, well, they take your money. So we talked about the lower liquidity with low volume stocks because it does make it harder to get in and out. We have wider spreads between the bid and ask price. So our transaction costs are a little bit more pricier. They're also very prone to volatility than higher ones because the lack of participants that provide stability through their buying and selling activity. Without those, we get these huge sudden price swings in every single direction. And so due to limited participation when it comes to traders, compared with the higher volume ones, there is a heightened risk of manipulation. And that goes back to our pump and dumpers. How about chasing hot stocks or trends without a proper analysis? This is dangerous. Let's think of AMC or GameStop and the huge moves that they made, both up and down. So one mistake that people make is they chase these hot stocks and they fail to analyze whether it fits into their overall trading strategy at all. So a good trader, they're going to establish a plan. They're going to have specific goals, specific objectives that they want to achieve through their trading. It doesn't matter what it is. Again, income, long-term capital appreciation, diversification, hedging, who knows? But they make sure with that, whatever they're doing, it fits the framework. And when you chase these hot stocks, these can't miss stocks, you neglect to assess your risk versus reward potential. And before entering into any trade, it's really important to understand how much money we can lose and consider what kind of returns could be expected if things go right. So this will help you decide whether you should take on additional risk. And also be aware of market sentiment. If everyone's bullish on a particular stock, well, there may not be much more upside potential left, but considerable downside risk associated with buying at higher levels. On the other hand, if everyone's bearish, well, there could potentially be some upside opportunity. There would also be significant downside risk depending on liquidity and other factors. So again, whether something is bull or bear heavy, you want to start to expect the opposite price movement, especially after extended runs. Go back to the charts of AMC or GameStop. You'll see that in action. Stop loss orders, big issue people don't do. They don't use them. But these are going to help protect you from these large losses. And for some reason, traders fail to put them on. Maybe they don't understand how they work or because they think it's going to limit their potential profits. But that thinking is costly because failing to use them can and will eventually lead to losses, especially in the event of some unexpected market turn. So for example, let's say you bought 100 shares of XYZ at $50 a share. You don't put a stop loss in. All of a sudden that stock just drops to $30 one day because of some news or some event. Well, you just lost $2,000. You had no protection from a stop loss order. So on the other hand, if you set up a simple 10% trailing stop, only an example, at $45 a share prior to buying XYZ stock, then your position would have been closed out before you drop below that last price level. So you got to be aware of the benefits of stop loss orders, how they work. You got to strive to take advantage of them because they also help you manage your trade. They're going to help you minimize potential losses. They're going to close out your positions once they reach a predetermined level. It's invaluable. If you're not using them, I don't know why. Issue: following the herd, the sheep, not making your own decisions. What is this? This is when traders fail to make independent decisions and they just follow what everyone else is doing. They're making decisions based on insufficient information, leads to bad choices if they follow the crowd. AMC, people were buying at the highs. And traders who rely on that herd mentality, they're going to end up making bad trades. It's that simple. And what is herd mentality? If you're thinking, what is that? It's just people's tendency to think and act in a similar way as those around them without considering any other alternatives or options. Traders may opt for a particular stock without assessing the company or the setups and just copy what other traders are doing on some forum. And why is it dangerous? Because you're relying on someone else's opinion. You don't have your own conclusion made. So if everyone starts buying a certain stock due to recent success, prices will likely increase until eventually it reaches a level that can't be sustained. And then it crashes back down to reality because people start selling off their stocks. And this phenomenon is actually known as herding behavior. And it's been linked to quite a few financial crises, especially Black Monday of 1987 and the Great Recession of 2008. And how can you avoid falling prey to it? Ignore social media. Ignore newsletters. Learn how to trade. We talked about review. An issue that a lot of people don't do is they don't review or track their trading. Without keeping tabs and reflecting on your trades, you might be left in a position where you're missing obvious errors or areas that require development. If you don't track and if you don't review your trading performance, again, it's going to lead to errors that could have been avoided simply if you would have just analyzed what you've been doing. When you track it and you review it, it can reveal patterns in your decision-making process, patterns in your trade execution. It can give you insights into your strengths as a trader. Your weaknesses as a trader can give you opportunities for improvement and the potential to increase your profits. So how do you do it? Well, the most effective way is use a spreadsheet such as Microsoft Excel or Google Sheets. Simple. You can monitor your results, assess which strategies are working best. And there's software programs out there that provide automated solutions. They have detailed charts and graphs and bells and whistles. Might be something to look at as well. So what should you look for when you review your trades? Concentrate on recognizing patterns in your decision making. Okay, don't just look at the outcome, right? Whether you made profits or not. Look at patterns. Take note of factors like risk management techniques that you used during each trade. What technical indicators did you use? Your state of mind on the trading day. This goes a long way in showing you how effective your strategy is and how your mental game is during the session. Listen, I talked a lot about stuff here, right? But this is really important. The key to successful stock trading, understanding the common mistakes that traders make and just avoid them. The temptation to go after a popular stock or follow some certain trend, it might be strong, but it's essential to take time for an accurate evaluation, to make informed decisions, and have good risk management if you want to achieve lasting success. Creating a well thought out strategy and managing risk and utilizing stop losses and monitoring your trades, it's going to help you avoid errors that could prove expensive. So with patience and discipline and avoiding common mistakes, and these are common and they're easily fixed, but you can become an experienced trader who profits from their trades without falling victim to the common pitfalls. We're talking about plans and risk. We have this guide here. It's called the 8-Minute Options Trading Cookbook, and it's got some powerful strategies that's going to help you generate income. We call it our secret recipe for winning big in the markets. We have 5 different paths to success on every trade with this one strategy. Anyways, it's a free download. The link is to the left here or down below in the description. I urge you to get this before we stop giving it away. All right, thanks for watching.